The risks are growing. I think it's going to be the worst bear market in the post-World War II era, probably the worst downturn since 1929 crash. I believe this top will likely not be exceeded again for decades.
Please join us for our next live stream, Sunday, May 23rd at 9 p.m. Eastern. We'll go over current events, past guests, and of course, gold and silver news. Once again, our next live stream will be Sunday, May 23rd, 9 p.m. Eastern. See you then. Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira. As always, if you're new to our channel or if you haven't already done so, please do subscribe, hit the bell to be notified on new updates, and give us a thumbs up. If you like what we do, we truly do appreciate your support. David Hunter, Chief Macro Strategist at Contrarian Macro Advisors, as well as the author of the Contrarian Value Advisor Letter, joins us today. Prior to that, David was a former CIO and fund manager with over 40 years of experience in investment and portfolio management. Having been a fund manager and analyst on Wall Street, handling everything from macros to pensions, and it's time to saddle up and silver up for David Hunter. David, welcome to SBTV. How are you doing?
I'm good, Patrick. Thanks for having me on.
David, as a macro analyst, you are predicting a stock market melt up in the next few months where you see the Dow at 3,800, S&P 4,700, NASDAQ 17,000, and gold to hit 2,500 USD and silver $45, $50 USD. Do you take this view because with the money printing, the stimulus, the Fed intervention, and all that going on, or is it something else that leads you to make this call?
Certainly the stimulus and stimulus from the government and all the money printing is contributing to it. And certainly a lot of the reason for the momentum behind it, but it's also where we are in the cycle. And I think this is a 39-year secular bull market, at least by my analysis, that started back in August of 1982. And we're coming to the end of that secular bull market. And at the end of long market cycles like that, you tend to get into a situation where the slope gets steeper and steeper, and ultimately ends in a parabolic blow off or melt up. And so that's part of it, is that I think we're approaching that, or we're in that last phase. But it's the whole thing. It's what happened with the pandemic led to, money printing like we've never seen in history. That finds its way into the capital markets. So certainly it's a big part of it. But that money then translates into a stronger economy and stronger earnings cycle. So there is a fundamental backdrop that's being caused by all the money printing.
Yeah, I was going to ask you, if the pandemic had not come about, would this cycle continue? Would we still be looking at, in your view, this melt up and meltdown and super cycle?
Certainly the pandemic changed the timing and the shape. But I was before, back in January of 2020, before the pandemic was, certainly for the States, was really even an idea. I was calling for a likely melt up into a top. My numbers have been adjusted upward a couple times in the last year, but I was looking for something in excess of 4,000 on the S&P back in January 2020, and I was expecting it to happen last year. Once the pandemic hit, I knew things were going to get stretched out and that, things would have a little different shape. So, but I believed we were coming to the end of that secular cycle regardless.
Okay, and so after this melt up, you stated that we're going to see stocks and equities markets go down by some 80% or so, far more than the 66% decline we saw back in the crisis of 2008, 2009. David, we don't have much time left if this happens in their time frame of just under a year away. What is this melt up, meltdown going to look like, and what should we do?
Yeah, as a strategist, I can't really provide advice. I can only provide forecasts, but I think people can see from my forecast that I'm I'm feeling like we're in a very late stage bull market that is going to have some probably spectacular run up into the top. So, from here, if the NASDAQ can go from, the low 13,000 area to 17,000, that's a 30% run from here. And S&P and Dow less than that, but still pretty big runs from here. So as much as I think we're coming to the end, we're not there yet, and there is some upside. On the other side of it, though, the risks are growing for a lot of reasons. And on the other side of this is, as you say, something that I think is going to be the worst bear market in the post-World War II era, probably the worst downturn since 1929 crash and the depression that followed. I'm calling it a global deflationary bust from an economic standpoint, and a bear market that, as you say, could be 70-80% downside. So people have to understand where they are in a cycle. And I know there's been a lot of, there's been a mantra out there for, a few decades that, you just buy and hold because the market always goes on to new highs over, cycle to cycle. I believe this top will likely not be exceeded again for decades. So in other words, if we get to, 38,000 on the Dow or 47 or 800 on the S&P or 17,000 on the NASDAQ, wherever the top is, and I think those numbers might prove low, but wherever the top is in coming months, I believe that those highs will stand for decades, not a decade, but decades. So that kind of begs the question about the mantra that says markets always go on to new highs, that they cycle down and then back up to new highs each. And the reason that's believed is because that's what's been going on for the last, 50 years, certainly, or longer. But that's not likely to be the case, after we make this high. So it just, I just tell people you have to realize where you are in terms of the big cycle as well.
And you also speak about a recovery phase. When will we know we are actually in that recovery phase?
Good question. Yeah, we've got to get through the bust first. I do think I use the term bust to differentiate it from a depression or a recession. I think it's something in between the two. It's damage that can look and feel like a depression, meaning there's going to be a lot of involuntary debt liquidation. There's going to be some real dislocation. But I think it happens much faster than a typical depression. If you use the Great Depression as the guide, that stretched out over many, many years. This is likely to be contained within kind of the timing of a recession, so maybe not much more than a year. So it'll have the damage greater than a normal recession, but happen fairly quickly. So that means that if we start it, let's say the bust, the market could top this summer, but if the bust begins, let's say later this year, towards the fourth quarter, you basically are looking at a 2022 that's going to be mostly a down year, but you might be coming out of the bust by, let's say, the end of 2022. The market typically leads that, so the market might be coming out of its bear market, much sooner than that, middle of next year, for example. And I'm just throwing, timing out there is impossible to know right now. So, who knows how fast the bear market will happen? It could happen in, 3 to 6 months, or it could stretch out for a year. So, that's gonna be something that you'll have to watch as you go along. As to when you're coming out the other side, if you use March of 2009 as an example, the market bottomed. The economy still looked awful for many months after that. So, you can't look for the economy to be turning around to determine when the bottom is. The market's generally going to turn several months before the economy. But that, I would say that's something we're going to have to kind of watch as we go along.
So, David, overall, you also believe that there is a bigger super cycle between the depression of the 1930s and what's coming in 2030. How did you conclude that there's a super cycle at work?
I believe super cycles exist between depressions. So the last depression was the 1930s. So let's say we started in, say, the early 1940s. And I believe the next depression is the 2030s. So, we're basically in the last decade before I think we hit that. At least that's how my analysis speaks. And that what a super cycle is, you tend to ratchet, ever higher. So the cycle, you go through ups and downs within it, what we call the cyclical moves. So you have cyclical bull and bear markets. You have, the recoveries and recessions. So, and all of that's contained within that super cycle. But at the end of a super cycle, you come crashing down, or you basically give up an awful lot of the gains you've gained through that super cycle. And that's what I think probably comes the end of this decade or early next decade. So I'm not saying the bust is the beginning of the end or is the end. There are voices out there that speak about us going down for the count in this decline. I do believe we have a recovery cycle that comes after the bust. It's going to be a different cycle. The cycles since 1982 have been disinflationary cycles. They've been pretty much consumer driven. I think the next cycle is going to be industrially driven, commodity driven, inflation driven. So really more like the 1970s. And we just got our CPI print today that was, off the charts, was higher than expected. And you're hearing people throw around the comparison to the 70s. You've got gas lines because of what happened to the pipeline. And you've got, a very high CPI print. So people are kind of knee-jerking that and jumping on the bandwagon of saying, here come the 1970s. And though I think they're coming, we're nowhere near that at this point. This will settle down. This one isn't we're not in 1979 ready to have the stagflation.
You touched on disinflation, and back in the 70s, we had high inflation, which we kind of touched on as well. And the Fed began to disinflate everything from then on since 1982. And the Fed induced disinflation brought on a stock market, secular bull market. Now, David, the Fed creating disinflation and then now wanting to get inflation, does the Fed, I just got to ask this, does the Fed really know what they want to do, or is the Fed starting to lose grasp of the economy?
I think there's a lot of misunderstanding out there about what the Fed is doing or is going to do. Keep in mind, in 1982 or in the early 1980s, we had 20% inflation rates. Paul Volcker was obviously head of the Fed at that time, Fed chairman at that time, and they changed, when he came on board, they changed policy from targeting interest rates to targeting money. We had many years of a Keynesian approach at the Fed where they were trying to target rates and let money go wherever it had to go to keep the rates low. And that's what led to the hyperinflation of the early 1980s. When Volcker came in, he basically in one fell swoop said, okay, we're cranking down money no matter what it does to interest rates. And that's why you had that big run up. We were at maybe 9% on the long bond. And in almost overnight went from 9% to 15%, certainly over a few months. And that was because they said we're not going to print enough money to keep rates at the level we're targeting. We're going to just make sure money doesn't grow and shut off the spigot that's creating the inflation. So that's what you had in the early 80s was that policy. So, and then, they had to adjust policy to make sure that, to try to keep the economy from going into depression. But I think the Fed at that time began a longer term process of saying, we're going to ratchet inflation down over time. We can't crank it down from 20 to zero in 1 year. But if we kind of manage our way through this and make sure money doesn't again ever get to that point where we're just kind of shoveling out the door, we will get inflation down. Maybe it'll take more than one cycle, but we'll get inflation down. I'm sure in 1982, nobody knew what it would look like 30 and 40 years later. But that inflation, I've said this, excuse me, I've said this for a long time, that inflation of the early 80s was created such an impression on an entire generation of economists, money managers, policymakers, that inflation kind of was the ghost that haunted people for the next 40 years. So every time inflation lifted its head, everybody got nervous, and that helped to kind of bring it back down again. We then got to the point in this last couple of years where inflation actually got down to zero. And when you get down to zero, or when you get down to very low inflation, the worry starts becoming, well, what if we can't lift inflation? What if we go into deflation? How do we solve that? That's a harder problem to solve if we really get into a deflationary depression. So that became, that kind of offset some of that inflation concern that had kept things under wraps. And then the pandemic hit, and it was like all stops are off. We've got to get this thing back on its feet. And they went from, $3 trillion balance sheet to, a $7.5 trillion Fed balance sheet. The federal government just kept expanding what they were going to put out there as fiscal relief to try to, offset an economic shutdown. And this is the same thing that happened around the world. So what you've got is, after 40 years of kind of managing policy to keep inflation under wraps, you now have, it's not so much to create inflation as much as it is to get an economy back on its feet after it took such a big hit from an unexpected situation. So, and now what the Fed's now trying to balance after a year of excessive money printing and a year of excessive government spending, what the Fed's now trying to do, and what I think the rest of the world's going to wrestle with at some point, is with a lag that creates inflation. And now they've got to say, well, maybe, and that's, I think, some of the real problem is that I'm not sure policymakers really understand. Frankly, a lot of money managers don't always understand the long lag time to when inflation comes. It's not a few months later, it's sometimes a couple of years later. So you do all this medicine, and then the patient starts showing, the side effects 2 years later. You can go far too far because you don't have that warnings. You have some warnings, but you don't have that full-blown inflation yet. So that's where we're at now, is inflation starting to lift above long-term downtrends that have been in place for 40 years. And policymakers are recognizing that it's becoming a risk, but they're also looking and saying, yeah, but we still have in the United States, 8 or 10 million people out of work, and certainly a lot of people beyond that are struggling because they can't work at the levels they were working before, for whatever, because of the virus or what have you. So, Powell's been pretty transparent about the fact that he wants to get that big chunk of unemployment down before he starts focusing in on you know, tightening policy or worrying about inflation. So today may change that a little bit. You know, the breakout today or the report today, but I think they're going to continue to stick with the idea that a lot of this is a supply side issue. A lot of the inflation, a lot of it is so-called transitory. I think they're going to stick by that, recognizing, I don't think they're blind to it, recognizing that some of this is not transitory. But, you know, my sense, I've been saying this for several months, my sense is the tightening is going to come this year, in spite of the fact that the Fed and a lot of economists are saying it won't come until late in 2022 or certainly later in 2022. I think we will see tightening this year. I actually think it may start by the end of the summer. But I don't think it's right now. I think you still have, you know, a few months here where they're going to, first of all, inflation, a one month print is not a trend. You know, we have seen inflation starting to pick up, and this is obviously the worst we've seen. But you can just easily, if gas prices come down and things like that, you can just easily see next month's number, you know, moderate some. So they're right not to react to one month's print. But the reality is inflation is picking up. All that money that was created in the last year plus is starting to push inflation. This is not all transitory. So I think they will grudgingly move to a tightening posture by the time we get to the end of the summer. As I say, I don't expect the tightening to necessarily be an increase in Fed fund rate. You know, I don't think it's necessarily going to be an interest rate hike. I think it will be more focused on pulling money out of the system, shrinking the balance sheet, you know, QT. But we'll see.
Yeah, I was going to ask you if, you know, if we do see, well, we are going to see inflation start to rise. I was going to ask you, do we have anyone that could be or would be a Paul Volcker in the Fed today?
I don't know that we do. I mean, I'm sure there are, you know, real hawks out there but Paul Volcker was, I mean, and people really who weren't there at the time cannot appreciate the job he had. I mean, it was a task beyond anything any Fed chairman had faced. And it took real guts, both from him and also, you know, administration, you know, President Reagan, to allow him to do it. But, you know, it's also a case that they really didn't have any choice. It was pay me now or pay me later. You know, the longer they waited, inflation was about to just keep accelerating. So that's why he came in. I mean, G. William Miller was who he replaced. G. William Miller had no real understanding of what he was doing or what, you know, he was a financier. He had run Textron and was a really strong CEO, but his expertise was in, you know, financing things, leveraged buyouts. You know, they built the conglomerate based on a model of borrowing and buying companies, and he was very good at that. But Carter appointed him Fed chairman because he was on the, you know, the Boston Fed board, and they needed a Democrat. Obviously, they wanted a Democrat in that position, and he picked him. And he really was over his head. He just was not an economist. So that's, you know, that's more the problem. Was the predecessor to Volcker created the problem. Jay Powell was a very competent chairman. I was as critical as anybody on Wall Street in 2018-19 in terms of how he was managing the Fed. And I was very outspoken about the fact I felt he was not up to the task, that he was learning on the job, and that we were in a tough time where you didn't want on-the-job training. I will tell you, ever since March of 2020, he learned fast. I have no criticism of him. He's got a tough job given what happened in the pandemic. But frankly, a lot of the criticism out there is undeserved. He's really done a spectacular job. So having a competent Fed chairman, he's not, his mindset is not a Paul Volcker, and times are different than then. But I think that's the bigger answer, is that we do have a competent Fed chairman. He's not dogmatic. He will adjust, and he's learned how to communicate. I think he's been very transparent. People want to try to read into his responses and say he's not being upfront or what. He's been. I think you can take what he said at his word. I mean, he really means what he's saying. He's trying to walk a line. They're trying to get the economy back. He does care about those people that were really hurt in the pandemic, and he's trying to get them back on their feet. But at the same time, he's not oblivious to the fact that policy has been very loose and that it can lead to inflation.
So let's say Powell, eventually he does have to take a look at raising rates, interest rates. How much of an interest rate hike do you think the markets can take, and how do you think the markets will react to maybe the very first interest rate rise?
Keep in mind, Fed fund rates are really zero. They're very low. It's the market that changes rates. Drives rates. So we had the run up from 0.6 10-year to a 1 3/4 10-year. Over the last many months, and it's dropped from there. I think back in early March, I changed my forecast and raised my expectations so that we will. My expectation is we will see a 2.5% 10-year this year, and we will see a 3% 30-year, but not straight from here. We're at 1.65 on the 10-year right now. I think that can move down to 1.2. And so bond rally in the next couple months, and then the tightening begins. And I think you'll see rates rise, inflation picks up more. So I expect it's more what the market does to rates that will be the dampening effect on the markets and the economy at some point. They could hike rates, a quarter or a half, but you're really, your short rates are so low, and you still do have to walk this line where you still have a fragile economy. So I think the market's going to be the one managing rates, and I think the Fed, as I said before, is going to be focused on QT, which means you could see them pull. And they won't start out with this expectation. But I think as inflation heats up, you could see the Fed ultimately pull $1 trillion out of the economy. So the balance sheet is $7.5 trillion right now, and they've been putting billions in a month. I think that will stop first, and then you'll start seeing money being pulled out. And ultimately, I think you could see the balance sheet shrink to $6.5 trillion. Now, last summer, in say June, July, August, in that period, the Fed actually reduced the balance sheet by a few $100 billion, and that helped probably put a cap on the market for a little while. We had that period in the fall where it didn't go anywhere. But that was only a couple months removed from the second quarter swoon, second quarter dip in the economy. Economy was shut down. So if they were willing to pull a few $100 billion out of the system back last July, I don't see why, if the economy is overheating and we're a year removed or more than a year removed from that dip, I don't see why we won't see $1 trillion come out. And $1 trillion in this fragile system could really be disruptive, and that may be the trigger for the unwind.
Okay, I'm just going to throw this question out there. Do you think the Fed pulling back some of that money or liquidity, do you think they might possibly do it through the reverse repo market? I mean, I've been watching it, and it's hundreds of billions a day that they've been in for recently.
Yeah, for sure. I mean, that's essentially one of their tools, and that's where I think you'll see it. Um, again, I don't know what they're doing right now. I don't watch it that closely, but I really think they are not going to get very tight for another several months. They they're doing repos and reverse repos all the time to kind of keep adjusting things. But in terms of an actual deliberate policy to pull money out of the system, I just don't think we're there yet.
Another view that you differ from some others is on your belief that the U.S. dollar will not lose its reserve currency status so quickly despite the rise of China or central bank digital currencies and so on. Can you elaborate how or why the USD maintains its reserve status?
Yeah, keep in mind, there's really nothing to replace it right now. Um, China's nowhere near a place where their currency would be trusted as a reserve currency. The IMF could do some sort of a basket, and that's probably what we'll see evolve at some point. But the dollar is still the dominant vehicle for trade, and in a time of turmoil and stuff, I just don't see that likely. What happens on Wall Street a lot, as you well know, is we've got a lot of overactive minds out there, and everybody's thinking every day, and so thoughts get poured out there. People kind of latch onto them and repeat them, and other people throw other things out, and it all gets bought into. Next thing you know, it's like, oh, it's going to happen any day now, and or next year, and these things play out over long periods of time. The dollar is still very dominant. We're seeing contracts for oil and things, direct contracts, Middle East to China, et cetera. So it's starting to happen that the dollar is becoming a little less important in trade. But my sense is that you're probably at least 4 or 5 years away from that becoming a real concern. In the bust, I expect the dollar to rally. I'm probably the biggest bear on the dollar, one of the bigger bears on the dollar right now, calling for the dollar to drop to at least 85, the dollar index to at least 85 from its current 91. And actually, I've said recently, I think more likely could drop down to the low 80s or 80. So that's a pretty big drop from here. And so you'll see the euro rise. You'll see the Aussie and Canadian dollars rise, British pound rise. So the dollar's going to look weak, and you're probably going to have a lot of voices out there jumping on the bandwagon saying, "Here we go, the dollar's losing status." But I think it's just the ebb and flow that we have, where you go through periods where the dollar's weak. It's been weak in the last year, obviously. And then I think in the bust, we're going to see the dollar is still not, that lost cause. I think you're going to see people run to the dollar for safety. I think the U.S., when push comes to shove and we get into crises, the dollar still is the place people run to. So I think you could see the dollar go from, say, low 80s all the way to 120, maybe even higher than that during the bust. So that obviously postpones any talk of dollar losing reserve status if people are running to it during a crisis. And then you probably have a couple more years after that to kind of stumble around. I think by the time you get to the middle of the decade, you can begin to worry that the dollar could really start to lose status.
Okay, so David, through this meltdown recovery phase, how do you think gold and silver will do?
Yeah, I'm a big bull on both gold and silver. I think near term, with inflation, starting to break out, with the dollar weak, with interest rates about to rally again, I think you're probably going to see the next couple months a pretty strong silver and gold market. I have a target of 2,500 for this year for gold, 45 to 50 for silver. I think you could see that, certainly by the end of the summer. It's always hard to time these things. You never know. I'm typically expecting things to happen sooner than they do, but I think could see it certainly this year, and I think certainly by fall. In terms of my longer forecast, I think they'll both get hit with most assets in the bust, but probably not nearly as hard as the stock market. So if the stock market falls 80% or 70%, I think the metals fall half of that. Certainly gold, probably less than silver. And then my longer term forecast for that inflationary recovery that I spoke of, where I think we retrace the last 40 years of disinflation. So we go into deflation during the bust, and then we fully retrace back to 20% inflation rates by the end of the decade. If we get that, I fully expect gold to be above 10,000, silver to be above 300. And how far above that is anyone's guess, but I think it could be substantially above those numbers.
Well, so there are definitely some things to look forward to and opportunities that will come about. David Hunter, before we wrap up, can you let our listeners know more about how they can find your work and how they can follow you on Twitter?
Sure. Yeah, most of the time I'm on Twitter almost every day with tweets and responding to people. So you can find me there at Dave H. Contrarian. And I also have an investment letter that I put out quarterly. It's by subscription, so it's not a free letter. If people are interested in it, the easiest way to contact me about the letter is to direct message me on Twitter.
Okay, David Hunter, we appreciate the time you've given. I enjoyed the chat. I think that you really laid out a pretty good map of sorts, or at least your vision of how you think things will be. So we appreciate that, and we appreciate you coming on and sharing it.
Thanks, Patrick. Good questions, and obviously it's a forecast. It's
Sure.
we'll see how it evolves. But I've been doing this a long time, and I think things we're in for a roller coaster ride, I think.
Yeah, I can agree. So buckle up. Usually I say saddle up in silver, but I think in this case we're also going to have to buckle up. David Hunter, appreciate your time,
right.
and yeah, agree also. Appreciate your time, and hope we can do it again soon.
Okay. Thanks, Patrick.
Thank you, David. Appreciate it. That was David Hunter, Chief Macro Strategist at Contrarian Macro Advisors. For more info about his work and his views on the economy, you can follow him on Twitter at Dave H. Contrarian. And if you like this video, please hit the like button and subscribe to the SBTV channel to be updated on new content. And do also check out the SBTV podcast on iTunes and Spotify.